Good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled How to Shift CRT Benefits to Children Under Today's Rules. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management, and in that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients, and this is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and non for profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning, and you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Finally, I recently published my first book, D is for Diversification, the ABCs of Personal Finance, which can now be purchased on Amazon or at jonathanonmoney.com. Today, we're privileged to hear from Evan Unzelman, CEO of CRT Experts LC based in Leesburg, Virginia. And Evan has over 20 years of specialized experience with charitable remainder trusts and is largely regarded as one of the nation's foremost experts on CRTs. Over the last 2 decades, he has reviewed thousands of CRTs and work with tens of thousands of CRT beneficiaries, their families, and their advisors on all facets of CRT planning, from upfront design to complex CRT administration to CRT secondary planning. Evan provides unique insight at every stage of the CRT lifecycle. And Evan's experience with CRT secondary planning, such as sales, gifts, and exchanges of CRT income interest, is particularly deep. Prior to forming CRT Experts, he was president of a charitable planning firm where he helped develop the secondary market for CRT income interest and personally oversaw the successful completion of the sale transactions for thousands of CRT beneficiaries across the U.S. Evan is a trusted resource for trusts and estate attorneys, CPAs, and financial advisors on all aspects of CRT planning. And today, Evan will be speaking on how to shift CRT benefits to children under today's tax rules. And with that introduction, I'll now turn the program over to Evan.
Thank you, Jonathan. It's great to be here and appreciate the opportunity to talk about what's turning into be quite a timely topic, which is shifting CRT benefits to children under today's tax rules. Before we talk about the techniques, it's important to understand why this conversation is happening more often today than it did 10 or 15 years ago. We'll look on the next slide at the age distribution of the existing CRTs in existence today. But as we'll see, a majority of CRTs, most CRTs in existence, were created in the 1990s and early 2000s. So we are 20 plus years out from the time when most CRTs out there were created. And what's significant about that is the individuals who created them. When we think about typically when we create a CRT, we're in our 50s, 60s. We fast forward 20 plus years, these clients are now in their 70s, 80s, and beyond. So typically when we think about a CRT, this is a long range planning vehicle because it's the income stream is tied to people's lifetimes. So at inception, it is. But the marketplace today, given the age of the outstanding CRTs that represent most of the marketplace, the opposite is true. These are relatively short duration assets tied to aging beneficiaries, and that just changes the planning dynamics. When we think about why do clients create CRTs, it's typically for two reasons. One, we have appreciated property, we want to sell that, and we want to defer the capital gains tax. That's the driver behind most CRT creations, is that it's that tax driver of deferring the capital gain. And then secondly, we want to create a lifetime income stream. When we think about the timing of those benefits, it's anything but equal. The tax benefits are garnered really early in the life of the CRT, using the first year or two. That's when we defer the capital gain, the exempt trust sells the asset. And if we take, or at least start taking, the charitable deduction that we get, and we can carry that forward for at most 5 years. So from a relatively early point in the overall CRT life cycle, really the sole benefit with respect to that trust is that income stream. And today, for these clients, because we're so far removed from the CRT inception, from creating the trust, that income is just no longer a priority. And more importantly, their planning goals have shifted to children and grandchildren. Their children are also 20 plus years older, in a very different spot in their lives, and their grandchildren, in many cases, weren't even born when these CRTs were created. So in short, the trust is still functioning exactly as drafted. It's irrevocable. It has to, right? That trust can't change, but it's no longer functioning as desired. So the question becomes, if the economic value of that income interest that the client owns is no longer in alignment with their goals and objectives today, what can be done with it? And that's what we'll examine here today. So this sort of sets the stage for the discussion. What you're looking at is the age distribution of existing CRTs. This is based on the most recent IRS data released on split interest trusts, charitable lead trusts, charitable remainder trusts. There's about 90,000 CRTs out there. So there is a lag on it. It's not a significant lag. This is based predominantly on 2022 split interest trust tax returns, the Form 5227 that CRTs file. And so when we look at the age of the marketplace, we break it down into 5-year increments here. And you can see in the most recent 5 years, so this is as of tax year 2022, so 2018 to 2022, only 5% of the CRTs in existence were created in that time frame. We go back to the prior 5 years, it's only 12%. So as you move down the chart, you can see something very telling in that 30% of CRTs that are out there today were created between 1998 and 2002, 28% before 1998. Most of those were in the 1990s. So 58% of the existing CRTs are more than 20 years old. That just shows you how many CRTs were created in the 90s and early 2000s. That a lot of the CRTs that were created are no longer in existence. The income beneficiaries have died. If they were term trusts, they've termed out. But there are just so many created back then that it still represents, those CRTs that are left still represent the majority of the marketplace. So more than half the CRT universe was created in a completely different planning environment. We think about the time when these trusts were established. We had an estate exemption of $1.5 million or $600,000 to $1.5 million. We had a 28% capital gain rate. So it's just a different planning environment. But more importantly, these clients are just in a different spot now. They're 20 plus years older. So these CRTs were perfectly rational decisions when they were created. But what we're evaluating today is not whether the CRT was a good decision at inception. It usually was. What we're asking is a different question. We're asking, given how much time has passed, does that original economic structure, those original terms that are irrevocable, still align with the client's objectives today? So when we think about these clients today, generally speaking, these clients 20 plus years later, that their balance sheets are stronger. In many cases, they don't need that CRT income anymore. In many cases, it's not just they don't need it, it's they don't want it. They're trying to reduce their taxable income, not maintain or increase it. And their children are adults. Their grandchildren, again, grandchildren that may not have existed when the CRTs are created, are now the focus of their planning. So their planning goals have shifted, but the trust is irrevocable. It can't shift along with those changing, the client's changing circumstances. We'll go back to the Brewers, Bill and Sandy, later when we look at a case study. But their situation, and we helped write an article for Kiplinger with their attorney on this particular client, because this really does typify the CRT life cycle. And is representative of all these CRTs out there today, where really good fits at inception, but the issue with the CRT is it's an irrevocable trust and it's around for a really long time. And that combination of irrevocable trust and a long duration can just naturally lead to misalignments later in that CRT life cycle. As the client's life starts to change, it's inevitable that trust can't flex because it's irrevocable, can't flex along with the client's changing lives. So you've got all these clients out there today asking, what can we do here? And unfortunately, many of those clients don't think that anything is possible. And that I think it creates a very specific opportunity for advisors. You have a large population of mature CRTs producing taxable income that's no longer needed, held by clients whose priorities have evolved. So the conversation becomes, if the CRT were being created today with today's facts and the client's objectives today, would we design it the same way? And if the answer is no, and as you would imagine it often is, then we have a planning discussion. So before we look specifically at the sale and rollover options, let's first answer sort of this threshold question of why does this flexibility exist? Why can we do what we're going to talk about here today? And we're going to see these are, with the sale and the rollover, very different options in terms of the outcomes, but they're rooted in the same thing, and that is the fact that the income interest in a charitable remainder trust is a capital asset. And so this roots back to a 1972 revenue ruling you can see up here on the screen. And what that revenue ruling says is that an income interest in a trust, not just a CRT in any trust, the life interest in a trust is a capital asset. So any CRT out there that's been in place for more than a year, the income interest holder, the income beneficiaries own a capital asset that can be bought and sold at the long-term capital gain rate, or can be used to create a new CRT. The problem is there's just not enough awareness out there from the client standpoint that these options are even available to them. So as a capital asset, we view it like a capital asset. That's what gives rise or gives us the flexibility to do what we'll talk about here today. Again, very different outcomes, but they're rooted in that capital asset treatment. So once we understand that an income interest is a CRT income interest is a transferable capital asset, that is what gives us two primary planning paths. The first is a sale. With the sale, the income beneficiary transfers their entire income interest to a third-party purchaser. This is a full disposition of the income interest. The seller, receives immediate liquidity. Importantly, this does not affect the trust. The trust is irrevocable. It's not affected by the transaction. The underlying terms are the same. The measuring lives are the same. The charitable remainder that stays intact. It's only that income stream that's changing hands, that capital asset. And this is, of course, going to be appropriate for any client with the CRT who wants liquidity. But in our context here today, where these clients are looking to shift the future economic benefit of their trust to kids, that's in our context, when we're talking about those clients, it's providing cash that they can redeploy for heirs, for grandchildren, and their children. So the second option is what we call a rollover. So instead of selling the income interest for cash, the beneficiary can contribute that to a newly created CRT. So this is a ground up build, a blank slate when we talk about that new CRT. So the client's attorney is drafting that new CRT per their goals today. And for the clients that we're talking about here today, that means we're drafting a CRT here. We're creating this CRT for the benefit of children, and we're going to fund and monetize that CRT with our income interest. So at a high level, really different outcomes. The sale is converting that income interest to cash to redeploy for children. The rollover option is redeploying that via an income stream from a new CRT. So they're both grounded in that capital asset treatment, but they accomplish different objectives as we'll see. So let's look first more closely at the sale option. So when a beneficiary sells their CRT interest, they're converting the right to future distributions into a lump sum cash payment. For the seller, there's no more ongoing income recognition. There's no more ongoing administration. For these clients who are older, we're talking about here today. That second point there, no more ongoing administration. I can't overstate that. Obviously, the goal here with the sale is liquidity that they can redeploy for their heirs. But it's probably a majority of the sellers that we work with at some point tell us, a really nice side benefit here is I get rid of this administration. With the sale, there's a change of trustee. The administration is going to shift over to the buyer. And for these clients who are at the point in their lives where they're trying to simplify their financial affairs, that administrative simplicity is a real benefit. But the core benefit, the key benefit is of course cash that they can redeploy for their heirs. Before we jump into the case study and look at the Brewer CRT, just an important point on CRT, the sale of the income interest we're talking about here today, which is a secondary market sale versus a CRT termination. So with a termination or a commutation, which is a division of the trust between the income and charitable remainder beneficiaries, the valuations there are done strictly under Section 7520 and the methodology under Section 664-4, i.e., this is a formulaic valuation. Whereas with the secondary market sale, we're not bound by, because we're not terminating the trust, we're not bound by those valuations. And what we've in almost 25 years now of doing these transactions, what we've seen is if we go price and income interest in the real world, and real world buyers are pricing those based on their own assumptions, it's typically going to price at a relatively significant premium to what the client would get if they terminated the CRT. So that's why, as long as the client's made aware of the sale, rarely do we see those terminations anymore. Conceptually, think of it like real estate, like another capital asset. We think about real estate. There's a government value, that assessed value. Typically, if we go sell that, list our property and sell it in the real world, we're going to get more than that government value. And that's analogous to the market value of a CRT income interest versus that termination value. So let's put some real world framework around this with our case study and Bill and Sandy Brewer. Again, real typical, very typical in terms of the fact pattern that we see with these CRTs that were created back in the 90s and early 2000s. We had appreciated real estate. They owned appreciated real estate. They wanted to sell that, defer the capital gain. At that time, their kids were high school aged, so they had private schools and travel sports and a big house. They were looking for income. They had an expensive lifestyle. And so the CRT was a perfect fit. It allowed them to defer that capital gain, and then it distributed income over their remaining lifetime. So that is 7% CRUT. And so it worked really well. Like a lot of these clients, they eventually got to the point where their lifestyle got much simpler. They're trying to decrease their taxable income, and their advisors were able to pretty much do that across the board, from their investment portfolios, real estate holdings. They're really down to this one last asset, and that was this income interest in this CRT. And they wondered, well, what can we do with this? We don't need this income. What can be done? And so their advisors approached us. We reviewed the CRT. They eventually sold their interest. But what I want to do here is walk through the valuation, so we can get an idea of, given a CRT here, 78 and 76-year-old, $2.5 million in the trust, 7% payout rate. This was not an MCRUT. This was just a standard CRUT. How does that price? And ultimately, that income interest, that's the economic value that we're shifting to the next generation or generations. And so I wanted to walk through that here now. So when we're valuing a CRT income stream, it's not a complicated valuation. There's just two key variables. One is the duration. So because most CRTs are tied to people's lifetimes, most often we're just going to be using mortality tables. We'll look usually at 3 here at CRT Experts. In this case, it gave us joint life expectancies for Bill and Sandy of 15, 17, and 19 years. So what that does is it puts a present value range, a valuation range, because obviously the value of that income stream at a 15, 17, and 19-year duration is going to be a little bit different. The second thing we need to estimate is the trust growth rate moving forward. With a 7% trust, we're always going to go based on what the clients or advisors, if they have views toward what they would want to use. Otherwise, by default, we're just going to peg that future growth rate to the trust distribution rate. That way, we get just a level stream of payments. So we assume that in this case, the trust is earning net of fees 7%, it's distributing 7%. So we've got this $175,000 annual income stream. And we look at that at those three valuations. We look at that at 15, 17, 19 years. And as you can see, that puts a range on that income interest from anywhere from just under 1.6 to just above 1.8 million. So that's our first, and that's our most realistic benchmark. We will look at that IRS valuation. This is that formulaic valuation that I mentioned earlier. If any of you use Crescendo, this will look familiar. This is their output, Crescendo Interactive Software. But whatever we're using, Easy Charitable, Number Cruncher, Tiger Tables, we're going to get the same value. We're going to get the same valuations because we're using that IRS interest rate. The IRS is using their own mortality tables, 2010 CM. We plug in the ages, payout rate, trust value, and that will give us two values. One would be the value of the charitable interest. The remainder interest, which we can see here, is $976,000. So if Bill and Sandy set up the CRT today, that would be the deduction that they would get based on the current value and their ages today. We're not interested in that value. We're interested in the other value, which is the IRS value of the income interest, which you can see is about $1.52 million. So you could see here, now we can start to put that valuation range. We're looking at different economic benchmarks. We can then obtain a secondary market price estimate. In this case, and they eventually sold their income interest for about $1.85 million. And this is indicative. This is illustrative of where these will typically price right around the top end of that valuation range. And you can see that IRS value is below even the bottom of that present value range. So you can see why if the client's goal is the flexibility of cash and they want the most money possible, the sale option is going to do that for them. So for Bill and Sandy, to go back to that life cycle slide, for them, the sale brought their CRT journey, if you will, to a satisfactory conclusion. Certainly, they had no qualms about the trust. It worked masterfully up front. It worked really well over time. It was just it had run its course, is something that we hear from a lot of sellers, and the sale allowed them to do that. Now, Bill and Sandy, they wanted the flexibility of the cash. They had real specific things they were looking to do for their kids and grandkids. But on paper, they really were also good fits for a CRT rollover. When we're talking about this subset of clients, the overarching goal is the same. It's I want to shift the remaining financial benefit from my trust to my heirs. So that's the overarching goal. So as we're ticking the boxes to get to that goal, the sale and rollover are the clients are the same, right? These clients in both cases, they don't need that or want that taxable income. They're looking for a way to shift the remaining benefit to their kids. Where the sale and the rollover, where the differences play a role is here. When we reach this decision node, okay, we know we want to shift that benefit. How do we want to do it? With the sale, the big benefit, of course, is the flexibility of the cash, but that is capital gain. So with the sale, this is a capital transaction. You're selling a capital asset. So the proceeds are long-term capital gain property. With the rollover, we don't have the flexibility of cash, but we can take that capital gain out of the equation for, in this case, Bill and Sandy. So with the rollover, and this is the way we hear a lot of clients describe it as, my kids are now of the age that we were, my spouse and I were when we set up this trust. It worked really well for us. I'd love to just to do the same thing for the kids. And that's in effect what the rollover is able to do. So instead of Bill and Sandy selling that income interest for cash, they create a new CRT, name their children as and grandchildren as the income beneficiaries, irrevocably contribute their income interest to the new CRT, and that will sell it. The buyer doesn't care who they're buying the old income interest from. They're going to pay $1,850,000, whether Bill and Sandy own it or this new CRT owns it. But the key difference here, obviously, besides the fact that the objective is being accomplished via income to the kids, the key difference in these two options is there's no capital gain to Bill and Sandy. So the seller is the new trust. So it's similar when they set up their CRT. They own this real estate. They had more than two, but the two relevant choices were I can sell this income interest for cash and pay the capital gain, or I can contribute it to this new CRT. We've just got another capital asset now, 20 plus years later. Their income interest in that old CRT, they can sell it for cash, or they can contribute that to a new CRT in this case, for their kids and grandkids. So it's the same economic value. It's that $1,850,000. That's what we're shifting down to that next generation. We're just going about accomplishing that objective differently. With the sale, that $1,850,000 is cash in Bill and Sandy's bank account, and they can redeploy that however they want. In their case, again, they did. I think they did immediate gift. They invested in a child's business, and then they did some college funding for their grandkids. So the cash gives them the flexibility to do that. With the rollover, that $1,850,000, that economic value is being dropped into a new CRT. So we're maintaining the tax exempt environment, and that new CRT will distribute income to the children. So there's no tax doesn't come into the picture until the distributions are going out to their kids. Of course, those are taxable at that time. So same economic value, different planning structure, and a different outcome for the clients. So hopefully it's a lot to pack into 25, 30 minutes. But hopefully this has been a good overview for everyone. Obviously, if you have clients for whom you think this may be appropriate, please get in touch with me. We do not charge a review of CRT. We don't need any documentation. We just need ages, payout rate, approximate trust value, and we can put this review together. That's really where it starts from the client standpoint, is awareness. We've been beating this drum now for almost 25 years in terms of trying to get the awareness down to that client level, that their income interest in the trust, that's a capital asset. They've got much better flexibility than they might think they have. And so it really starts with that review. And of course, if the client's interested in pursuing these options, we're happy to assist. But CRTs are all we do here. So even if you just have a general question about CRTs, CRT design, CRT administration, or what we talked about here today, we're always happy to kick that stuff around. But Jonathan, really appreciate the opportunity to come on today and talk about hopefully what I've demonstrated here is a timely topic when it comes to clients with existing CRTs.
Great. And thank you so much, Evan. And if anyone has any specific questions, new business opportunities, or any other issues I'd like to discuss, you could feel free to reach out directly to Evan or myself where appropriate, and I'll be sure to include his contact information in the follow-up email to this program as well. Three more quick items before I let you go today. First, my next webinar is on Thursday, March 12th, on highlights of the 2026 Heckerling Institute on Estate Planning, featuring Kevin Matz, who's a partner at Aaron Fox Schiff LLP based in New York. And I'll be sure to send out the invitation to this program in the coming days. In the meantime, if you have a friend or colleague who'd find these webinars of interest, they can subscribe to my webinar distribution list by simply emailing me with the word webinar in the subject line. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on X and Instagram at Jonathan on Money by connecting with me on LinkedIn. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.